Welcome to DoubleLine's second annual Roundtable Prime, moderated by DoubleLine Deputy CEO Jeffrey Sherman. 5 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Roundtable Prime was recorded on January 5th, 2021, and will be divided into 3 segments: global macroeconomy, financial markets, and best ideas. Each segment will be released separately once a week for 3 weeks in January. The roundtable guests, all with decades of experience in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array of knowledge across different sectors of the financial markets, including fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator, and our host. Jeffrey Sherman will moderate today's discussions. Mr. Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests and was named one of the 10 must-listen podcasts by Business Insider in 2020. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 45 years, Ed has been ranked by Institutional Investor Poll of Investors for economics and ranked number 1 for 35 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equities, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIAZI Fixed Income Hall of Fame. Danielle DiMartino Booth. Danielle DiMartino Booth is CEO and Chief Strategist for Quill Intelligence, a research and analytics firm whose commentary appears in the Daily Feather and the Weekly Quill. Prior to Quill, she served throughout the credit crisis as advisor to Richard Fisher, president of the Federal Reserve Bank of Dallas. She is author of Fed Up, an insider's take on why the Fed is bad for America. David Rosenberg is president and chief economist and strategist of Rosenberg Research Associates, an economic consulting firm providing analysis and insights to investors. Prior to founding his firm, he was chief economist and strategist at Gluskin Sheff & Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analyst rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine, will now open the first of 3 segments of Roundtable Prime: Global Macroeconomy, State of Play and Outlook.
All right, everybody, welcome to the second annual Roundtable Prime, hosted by DoubleLine and Jeffrey Gundlach. I'm Jeff Sherman. I'm the Deputy Chief Investment Officer at DoubleLine, and I'll be moderating the discussion today between our distinguished experts in their fields. And so we've all heard the introductions of everyone's background. So why don't we just jump into the meat of it and let's get the conversation going. So for this first segment, what I really want to do is talk about the macroeconomic landscape. And I think back to 2020, and there's a lot of things that come to mind, of course, what a crazy year that we all experienced. But I think unprecedented was a word that was used an unprecedented amount when describing 2020, whether it's the pandemic, whether it's fiscal response, whether it's the monetary response. And so I want to start there and think about the government side of the equation. on the fiscal side of the equation. And we've really never seen Congress in the US respond with the magnitude and the speed, although it didn't feel like it was very quick at the time, that they did in 2020, responding to what was the pandemic. And so as you think about the response mechanism from Congress, what is the first thing that comes to mind? So maybe Rosie, I'll start with you as our obligatory Canadian here. Tell us what you think about the U.S. Response to the fiscal response to the pandemic in 2020.
Well, I think the initial fiscal response, which was the CARES Act, was 100% necessary, if anything, to preserve social stability. But also it was 100% necessary to compensate people from either losing their job or being forced to stay at home because of this exogenous shock called the pandemic, and of course reinforced by the lockdowns. So the initial round, I wouldn't even call it fiscal stimulus. In fact, I wouldn't call any of it fiscal stimulus. It's all been basically an income transfer. What I found, I guess, more disappointing is that we continue on with these policies of income replacement or income transfer, but nobody's really targeting anymore to the proceeds going to households that really need it. It's not just going to people that are unemployed. And I think that's a bit of a disappointment and disincentive. I would have crafted something in this latest round that would have been a lot more targeted. My biggest concern, I guess, going forward is this. You know, there's no doubt that the income transfer has been necessary, but there's been nothing that's been done on the fiscal side to have any sort of productivity payback. We continue, of course, to assume that there's a light at the end of the tunnel. This is all temporary, but you have to start wondering at some point, does this morph into something more serious? Which is a universal basic income, just as an example. Like, at what point does this become morphing the U.S. into some sort of welfare state? My preference would have been, by this time, not just relying on income replenishment, the income transfers. I mean, we're in a situation now, for the first time in recorded history, you got to go back to the 1930s, where 20% of personal income is accounted for by government transfers to the personal sector. You know, how sustainable is that? I think by this time we should have already embarked on something a lot meatier. And I'll invoke FDR's New Deal. And the New Deal was a funky deal. Not everything was great in the New Deal. We all knew that. But ultimately, FDR realized that the best way to keep people engaged in the labor market is to actually give them a job, any job. And in the Depression, a lot of jobs were lost forever. This time around, a lot of jobs are going to be lost for a long period of time. And so people are going to have to get retrained, redeployed into the labor market. I mean, when you're taking a look at the number of marginally attached workers right now to the labor market, it's double what it was a year ago. So what we want to avoid right now is a permanent impairment to the labor market coming out of this shock. And so it's very interesting to me that when you're taking a look at the fiscal policy response to the Great Depression in the 1930s, it was all about infrastructure. It was about road infrastructure, transportation infrastructure. It was about building national parks, and something that ultimately had a big productivity payback down the road. Very interesting that by 1937, after running up the deficit for 5 years, the US government was actually back into a balanced budget position. That was with FDR. 5 years after the fact. So I'm a little disappointed that we haven't seen something that puts people to work, pays people to work, as opposed to a policy that continues to pay people not to work. I guess that's where I come out of this.
Jeremy, you're nodding your head there. What are your comments about this this fiscal replacement?
Yeah, I want to emphasize something that Dave said at the beginning. I normally consider myself, more of a libertarian-leaning person, and this time I was all for all of the stimulus or the government assistance that we did. And I've likened it to the takings clause of the Fifth Amendment, in the one where you have the right to remain silent. It also has in there too, if the government takes something from you, and the example everybody uses is they take your house to build a highway over it, they have to pay you for it. They can't just take things from you without nothing. Well, and it might be very well and good that they need to build the highway. Well, they took your job from you. They told you you couldn't go to work. They forced businesses to close. So in that instance, I do think that it was very necessary that we did what we've seen with the CARES Act and with the other stimulus acts as well too. Where I'm concerned is, where are we going to go with this? Right now, if you ask most people, what has been the result of the government stimulus? It's been to help the unemployed. It's been to help the poor. Now, maybe it hasn't been as efficient as we'd like it, but they're better off with it or without it. And it's led to helping the wealthy with higher asset prices as well too. So right now, everybody has won. There has been no loser in this game. So when Dave asked about universal basic income, of course, we're going to go right down that road. We're going to keep doing, we're going to do $2,000, whether it's next week or during the Biden administration. We're going to do more after that. And I fear we're going to just keep going and more and more and more until there is an adverse outcome. My thought of the adverse outcome is inflation. And that once we get it, then we'll start the pullback. But if the answer is, oh, we're going to do all these programs and everybody's going to benefit and the stock market's going to go up, and then we're just going to somewhere in 21 say, okay, that's enough and we're going to stop doing it. Nope, we're just going to keep going. And I think as we move forward into 21, until there is an adverse outcome, UBI, MMT are going to be even more discussed now than they've been discussed in the previous year or two.
So as you think about adverse outcomes, Jeffrey, paint another adverse scenario of this MMT UBI scenario besides just inflation. Is there anything else you can think of that could be problematic, which would cause the fiscal authorities to reverse course?
Well, I think ultimately people want self-fulfillment and they want self-actualization. And to go back to what Rosie was saying, if you pay people to not work, you really are in an unsustainable situation with basically mental health and societal stability. And I really completely agree that with Jim, Bianco, and Rosie, that we really embarked on UBI, and it seems that we're pretty far into it already, even though we don't talk about it with those words, where you have every 6 months the perception that you need some further amount of stimulus. And while Joe Biden is very vague about what his ideas are or policies, he does say that he wants more stimulus. And so we're well on that track. And you can't, the FDR example is quite good. I mean, you created sort of make work jobs, but things got built. To pay people to not work creates absolutely nothing. And who's actually been enriched here, just to use a one company placeholder, and I'm using this as a placeholder for a widespread phenomenon. Who's gotten rich? Well, the people that run Netflix, the people that run Amazon, they've gotten rich. The people that run virtual stuff, and yet there's almost no employment in a lot of these areas. A huge percentage of the stock market's valuation is technology, and only 2% of employment is in technology. And so it creates further tensions to the society. What fuels that further, though, is the inflation that you mentioned and asked me not to speak about. But the inflation in food could be pretty serious. We've already seen some pretty impressive bottoming in parts of the commodities market, which had been completely asleep for years and years. And now we're starting to see what looks to be a convincing reversal. And so I think that when food prices start to go up, I think that becomes a direct problem with the happiness of the people who are getting government payments. And you almost have to keep upping the ante. And it's not a solution. It's not an end game. It's a papering over of what's hoped to be a temporary problem. But as Jim Bianco said perfectly, there's been no real big losers yet. And when the food inflation comes, there will be perceptions of losers that will lead to further, as if we don't have enough social unrest relative to, say, 25 years ago, I would love to be able to go into a time machine and go back to 1995 and try to get a feel again of what the vibe was, how people felt about the institutions of society and how things were functioning, because I'm pretty sure it would be shockingly different from where we are now. It's like the tires on the car, the example I always use. You know, you drive a car and the tires get thin, and when you change the tires, I drive a Porsche, so this is particularly poignant for a sports car. When you get the new tires, you just can't believe how good it handles. For like the first half an hour you drive it, it's just unreal. And yet you never felt that it slipped that far. So these things happen gradualistically, and then all of a sudden it accumulates to a level where your eyes kind of pop out of your head and you say, this is a remarkable shift. And I think that that's happening day by day by day, but it's so gradual that you don't feel it. And then all of a sudden, as Jim Bianco says, there will be an adverse outcome. Are riots in the streets already an adverse outcome? Are massive homeless encampments? I mean, the homeless encampments in Southern California have exploded. It's really shocking. Areas that were considered to be, and still are, high value, but are considered to be nice areas, are overrun with homeless situations. So that, I believe, is just going to keep getting worse until it hits a breaking point.
Right. So we're talking about UBI. We're talking about potentially it leading to some form of inflation. Danielle, picking up from your background too, as a Fed insider, is it any coincidence that the Fed is now talking about some form of an average inflation targeting as one of their policy? We saw Evans hit the tape yesterday talking about he wants a 2.5% inflation. If we only do tens of basis points above, the 2%, it's not enough. I think I saw some other folks hit the tape say, well, maybe we could get that high. But is it a coincidence that they're adopting this policy to let inflation run a little bit hotter than it has? And what are the ramifications there? Does that become an inflationary spiral?
Well, I think there's a fundamental misunderstanding inside the Fed about how inflation begins. I don't think it's necessarily something that is quite as gradual as what they're describing if it decides to rear its ugly head. So it's a situation of watching very carefully what they're asking for. If you look at the reaction in the 10-year pre and post the implementation of average inflation targeting, you got all of 9 or 10 basis points. Woo! And that's why the Fed now owns more than a fifth of the TIPS market. It's had to literally buy the narrative and continue feeding this idea of increased inflation expectations in the face of rising permanent unemployment that they've proven they've completely failed on their second mandate in this crisis. It's never been on such stark display that they cannot maximize employment. And so I think that it's going to be a situation where if you do push the envelope too far, I mean, right now, for example, on everybody's points on infrastructure and FDR and public-private partnerships, there are 30 airports in China right now in some state of construction or repair or improvement, 30 airports. And we're getting, the IRR on our fiscal investment is zero. Germany provides a great example of reskilling its workforce. There are countless displaced oil and gas workers throughout, Texas, all the way up to the middle of the country. They could be easily moved, and yet the Fed is focused on the absolute wrong thing. And by the way, they've got the mother of all facilitators. And I think I used the correct sex there, because we've got Janet Yellen coming in at Treasury, a woman who is bitter that as a labor economist trained at Berkeley, she was never able to deliver on that labor mandate, but she completely understands the mechanism through which to deliver directly universal basic income. If you want to factor Wall Street out of the equation so that they can quit denying that the wealth effect is meaningless, then you figure out a way to directly monetize the debt. In order to do that, it cannot just come from the Fed. You have to have somebody in the administration advocating for it, going to the Hill, explaining it. And she speaks so nicely and softly, and she can connect both sides of the aisle. And so you have a very unique point in US history when, as opposed to looking at the 1951 Accord that separated the Treasury from the Federal Reserve, you're looking at a much closer merger going into the Biden administration with Janet Yellen at the helm of Treasury. So again, if these things are formalized to all the extensive work that Jim has done on this subject, you could very easily see a situation where they go to jawboning at, average inflation and saying, we'll let it run hot and we welcome it, to all of a sudden losing control, completely losing control and being very wary of what they'd asked for, because they get inflation so much hotter than what it is if you end up reopening the Federal Reserve Act of 1913 and allowing for the direct monetization of debt such that you can implement helicopter money, direct deposits into people's accounts.
Right, and we've seen that too with the discussion about central bank digital currencies, for instance, where it's an easier mechanism to really get people money and target it, more poignantly than they have in this last round. I think they'll always use a crisis, right? The old saying's never let a good crisis go to waste, and so you can point to this. So, Ed, thinking about all these new mechanisms to create money, to distribute it to people, you were our most bullish guest last year. Turns out you win the accolade for being correct there. How are you thinking about the world as we look at 2021 right now?
If you have to go back to your original question, in the spring of last year, we had $2 trillion in fiscal stimulus, and the Fed announced unlimited QE, and the cut rates to zero. And the stock markets took off 70, 80%. And so far not mentioned in this discussion, house prices have gone up, probably 15%. And when you get to house prices, maybe Bill Gates owns 80% of the stock market, but he doesn't own 80% of the house price market. And so you start to create a wealth effect. So Jeffrey, I think you raised a very disturbing point about the homeless situation and the bifurcation and the polarization in the U.S. economy, which is a whole other topic. But here we are today, and I will say to all of you, it's been tough as nails to get inflation to go up. And you keep acting like it's going to take off any second after a decade. It's amazing. Now, I'm ready for it to take off, and certainly commodity prices have moved up a lot. And we looked just before we started this, so oil is $50 on WTI today. So I'm ready for inflation to pick up, but I'm not over anxious. I think the main thing you have to get for inflation to pick up is for wages to pick up. And so far, that's been a tough picture. But moving forward, as you know, we've had a complete V-shaped upturn. So 30% in the third quarter, and we don't know the fourth quarter yet. I'm estimating something like 8. But it's been pretty strong. And somebody should mention the unemployment rate. I mean, the unemployment rate is so much lower. There's no one here in this group that would have thought it would have gone down as much as it's gone down. But in any event, I'm really getting out over my skis. $900 billion in the first quarter is the fiscal stimulus. And I calculate that could give you 30% real GDP growth. So disposable income will go up 60. So there are a couple aspects in our work. One is forecasting, and the other is just counting. And the 60% is just counting. Of the 900 billion, 500 goes to consumers. So the saving rate will be back over 20% in the first quarter. And I don't really know how fast GDP is going to be, but it could be crazy. And then our team in Washington thinks we'll get another 500 billion in the second quarter. And I haven't even begun to work that in. And then as you go through the year, you start to get the vaccination giving the reopening. And there's still a lot of the economy that is shut down. You guys in California are right in the front line of that. But sporting events, hotels, airlines, and so when you get the vaccination pretty well spread out in the second half of the year, I think growth could be as fast as 15% as you reopen those parts of the economy. But I don't need to go there now. I'm just saying, once it's growth is pretty good. I worry a lot about the unintended consequences of what we're doing, but I don't know how to stop myself and turn bearish on that. I just did the numbers this morning. They had the money supply for the Eurozone come out. It's up 12%. And it's up 11%. And the UK came out yesterday, it's up 12%. China's up 11, we're up 25. So if you add those up, they're up about 15%. They're in the neighborhood of $70 trillion. So man, whether it's Bitcoin or gold or house prices or equity prices, we are inflating this economy like crazy. And I don't know exactly what direction it's going to veer off, but there's always a chance it might veer off in a positive direction. But we'll see. I'm a bit for later on. I want to talk a little bit about the Roaring '20s, but let me stop here.
Okay, on that note, Rosie, you've been one to really focus on the deflationary aspect. So we talk about this amount of just global increase of the monetary base. It's not just the US, and Ed rattled off a lot of numbers. We were looking at something where yesterday we were in a meeting looking at the global monetary supply decreased something like 12 to 15% last year. Again, assuming those measurements are correct. How does one reconcile all this monetary increase versus a kind of deflationary effects of essentially not being productive with this monetary base that we're using?
Well, look, to construct an inflation view based on the money supply, you have to have a view as to what's happening with money velocity. So if you're going to forecast inflation just with M and not with V, you're going to be lost. And so what's happening is that the money supply, the monetary base, all the monetary aggregates are booming. They're booming faster than they were in the 1970s. But then you have to go to the asset side of the commercial banking system, not just the liability side, which is what the M's are. Bank credit is slowing down precipitously. We were talking before about all the stimulus that Ed's talking about. Well, the reality is that the New York Fed has already laid the cards on the table and told us that 3/4 of this fiscal transfer has actually gone to either boost savings, hence the stock market or financial assets, or to pay down debt. This is totally unpatriotic to even talk about the fact that credit card balances are down to the lowest level in over 3 years. When has that happened before? That's the people that actually don't need the money to live. That's what I'm talking about, the fiscal, quote, stimulus. We're giving money to people that they don't really need to live. So they'll play the stock market or they'll improve their balance sheet. That's fine. Doesn't do anything directly to aggregate demand. Meanwhile, what you should be doing is helping people subsist and get by. And so that's the real folly with fiscal policy. So the other aspect to what Ed was talking about is it's impossible to really have a GDP forecast with any realm of confidence in this uncertain and volatile environment without talking about where the savings rate's going. I agree with that, but if the savings rate's going above 20%, I have a tough time thinking we're going to have a really big consumer spending boom. And remember that the money that the government should be giving people in this income transfer is to help them get by, but they're not targeting it like that. And so back to the point, velocity of money has to accelerate to bump against the money supply growth. This is where all the experts got it wrong the last 10 years because they weren't focused on money velocity. and that was the offset and why we never got the big inflation. I mean, inflation at some point, look, core inflation bottomed in 2010 at 0.6. It did get up to 2 actually a year ago. It did get up to 2, and now it's below 2. We got some cyclical inflation, but it was still the lowest peak in core inflation on record. Was the peak that we got in the last cycle, which is barely above 2%. Think about that. I think as Ed Hyman had mentioned. I mean, we had QE, we had repeated QE in the last cycle. In fact, we had the re-expansion of QE in 2019, and the Fed didn't start to raise interest rates really till the end of 2015. We actually had gargantuan fiscal stimulus, right? Starting with Obama's spending plan. The other side was the big tax cuts. Where did the inflation? There's a lot of structural factors that are impeding the inflationary process. I think one of them is the aging demographics in the developed world. Point number one. The aging demographics is hitting China. Okay, so we're here talking about the United States. There's no country in the world that's got as hot GDP growth as China does right now. China was the first economy to recover. You could argue that 6% growth, they're in a boom. They're about to deflate. Do you see where their CPI numbers are? Their CPI numbers are close to zero. Their PPI numbers are still deflating, and this is the hottest economy in the world. We've had decades of Japan. I mean, everybody's talking about all the monetary stimulus, the fiscal stimulus. Look at where Japan's debt ratio is. Look at their money supply numbers. Where's the inflation in Japan? People talked about, are we going to follow Japan as Japanification? We're there. There are structural forces at play. We might be in a situation where the marginal benefit of all the debt is actually more deflationary than inflationary. Everybody talks about fiscal policy in a certain framework, but nobody ever talks about something called recurring equivalence, which is that at some point someone's got to pay for this. Maybe we'll get MMT, maybe we'll get the big bomb, maybe we'll get the inflation. Right now, that's a theory. But let's just talk about the reality. We have the template in Japan. We have the template in China. We can actually go to Europe. Go to Europe, where the central bank has gone much further than the Fed ever did for a lot longer. Now, you could argue they haven't fiscally reflated as much. Well, we'll go to Japan. The reality is that, and when you go to the United States, here's what it is, that when you actually look at the data, you'll see that over the past 10, 20, 30 years, and now more than ever, home country inflation is increasingly determined by global inflation. We don't live on an island. And so a lot of what's happening globally has come onto our shores as well. But if we have learned anything in the past 10 years, now you can argue, well, they're doing more QE. They're doing more fiscal. Well, guess what? We had at full employment, 3.5% unemployment rate, 10 years of economic expansion. We had a 5-fold increase in the stock market. And the peak of inflation was barely more than 2% in the last cycle. We went into this thing with a $1 trillion deficit. I mean, unheard of in a peacetime economy. And that's all you get for your money. So I'll just say this much to finish off here. We have an output gap, as difficult as it is to estimate. But you know what? I will leave it to the CBO to do the work for us. We have an output gap of 5.5%. We know for a fact that when you look at the U6, we have 1 in 8 people in America that are either unemployed or underemployed. Ed said before, you need the wage creation. Exactly. We have basically 1 in 8 people in America that are unemployed or underemployed. You ain't getting a wage cycle out of that, at least not yet. And what's the cap you rate in industry? Hello, it's 73%. Well, that thing's got to get to at least 78%. The excess capacity in the product market and in the labor market is way too high. Now, I could see maybe down the road, we'll finally get the inflation. We've been calling for that forever. But let's say for the here and now, and you're drawing the aggregate supply, aggregate demand curve in the United States. Well, let's talk about the US. Let's not even talk about what's happening in the rest of the world. We're in too deep of a hole. We have the same output gap in the US economy today. Now, I know people look at the stock market and they look at credit spreads and make up their minds about what this means for the economy. We have the same level of excess supply in the US economy writ large as we had in the fourth quarter 2008 when Lehman got obliterated. and we were in a deep recession. Now we're not in a deep recession anymore, but we still have the sizable output gap. And notwithstanding how much we're going to fiscally reflate, it's going to take a long time before that output gap starts to close enough. You start to get the narrowing gap between aggregate demand and aggregate supply that will start to get the conditions for inflation. That might be at least 3 or 4 years away. I mean, it's out there, but when I say it's out there, I mean it's really out there. There's just too much excess capacity right now to be worried about inflation. And I guess we'll have to keep a firm eye on the gap, on the labor force participation rate in particular, insofar as that is going to tell us about the supply constraints in the labor market. Maybe wages come back sooner. Labor force participation rate, the output gap, money velocity, those are the things we should be really watching before we start talking about how all these other influences are going to create the conditions for inflation that didn't manage to do it over the course of the past 10 years.